Today's Talk About It Tuesday question is, I want to purchase my first investment property, but I don't have enough in savings for the down payment and closing costs. I'm considering borrowing from my 401k. What are the pros and cons of borrowing from my 401k to cover the cost of the down payment and closing costs? Okay, this is a great question, and a lot of people do that for their first property because we've heard the concept of leveraging, right? So you borrow against one asset in order to get another asset. I have very strict rules in that regard for myself, meaning two things that are important. I will never risk an asset that if I end up losing it, it's catastrophic to me. So, for instance, for me, my primary residence, my home, I would never leverage to try to get another asset, because if I lose my home, that's to me a catastrophic fail that I don't want to experience. I would also never leverage an asset that has extreme emotional value to me. So if it was a family heirloom, some type of art that had an emotional meaning to me, an emotional attachment, I would never leverage that. My second rule really is, though, that whatever you borrow to purchase should cover the cost of servicing that debt. And so if I borrow from one asset to get another asset, that new asset should cover the cost of servicing the debt on the other asset. So those are my two hard and fast rules, right? I won't leverage an asset that I can't lose, whether it's emotional or some other attachment. And I will never leverage it to get an asset that doesn't cover the cost of servicing the debt. So that being said, a 401k, if you don't know, is a tax-deferred retirement account. Usually it's offered by your employer. There are certain benefits to that, meaning pre-tax money comes out of your salary to invest in this retirement account. Oftentimes there's an employer match. They'll match whatever you contribute to it. Drawbacks, you cannot withdraw without a penalty until you're 59 and a half, and you must make a withdrawal at 73. And when it does get taxed, when you do withdraw it, you don't pay capital gains rate, you pay your earned income rate tax on it. So that's pretty much how it works. It is still an asset, and you can borrow against any asset. So in this case, the person wants to borrow against their 401k in order to purchase a piece of real estate. So you have certain pros from borrowing, just period, to buy any asset after. You are pre-approved, right? So there's not an approval process that you have to go through, because you are able to borrow up to 50% of your vested balance, or $50,000, whichever is the most. So meaning the max you can borrow is $50,000 if you have at least $100,000 available. And if you have less than that, then half of what your vested amount is. So you have pretty much a guaranteed $50,000 loan. So there's no credit check. You don't have to worry about that. Interest-wise, currently I believe the rates are between 8.5% and 10.5%. The good thing is you're not paying that interest to a bank. You're paying it actually back to yourself, which is an interest requirement, but you're paying that money back to yourself, which can offset some of the losses that you're going to incur because that money's not invested. Let me see what other pros. So, it's pretty quick. So it's quicker than applying for other types of small loans, and I believe it's definitely cheaper than credit cards and personal loans. So the interest rate is relatively low, guaranteed access. You're paying yourself back as opposed to paying a bank. They do have a setup fee. There's usually a fee attached to it, but it's very small. So those are the pros. You pretty much know you're going to get the money at a decent interest rate. So let's talk about the cons, because there's always a trade-off for everything. So you're sacrificing your future for right now. And what does that look like? while the money is borrowed, it is not invested, which means it is not contributing to your compounded growth. It is not contributing to your gains while it is not in the investment because you borrowed it. And even though you're paying yourself back between 8.5% and 10.5%, if the market is doing better than that, you kind of end up net negative in that regard. So if the investment doesn't make up the difference, because you're banking on, I'm going to borrow this money, put it in here, and whatever losses I would have gotten on this side, I will gain more than the losses on the other side in the other investment. So you're taking a calculated risk that the real estate will make up the difference between what you lost in regards to borrowing. So that's basically what we call opportunity cost. The other thing is the loan repayment. So you have 5 years to pay it back. If for some reason you lost your job or you leave the job, that loan is usually accelerated and due automatically. And if you do not pay it back in full, they will consider it a withdrawal, right? An early withdrawal. So what comes with an early withdrawal is automatic 10% penalty, plus it triggers your earned income tax rate. So if you're in a, say 22% tax bracket and you got to 10%, that's effectively 32% of that money that automatically is gone. Of course, we know the other risk is that the market, you might not be able to make that money up because of market fluctuation. So when your money's back in, the market could be depressed and then you don't make up the money that you lost while you weren't there. Those are pretty much the other thing is you're paying the loan back with after-tax dollars, right? It's a payroll deduction, but it's not like with your 401k, which is pre-tax. You're actually paying back, so you actually get taxed twice, right? It's technically a double taxation. With post-tax dollars, you're paying into the tax deferred. You're paying back into your tax deferred annuity, and then when it comes out at the end, you get taxed on it again because what's in the 401k is usually pre-tax money, so it's taxed when you withdraw. So there is a double taxation equation also. So the question is, should you borrow from your 401k? Well, it boils down to doing the numbers and following certain criteria. So is it okay? Do you have if you weren't able to pay back the 401k, can you withstand the penalty, which is the 10% plus your earned income rate? Can you make up the difference in what you lost in the 401k investments by purchasing the real estate? Will that cover whatever losses you had and then give you more gain on the other side? It's really a question of numbers, right? The risk is minimal. You know what the risks are, but it's good to go in understanding the risks, understanding the numbers, where it works out best. Does it work out better, to pull from it and get another asset, or to leave it there? Which one works out better? Maybe you find another way to get or maybe you just wait. Maybe that's not the deal for you if it's time sensitive. Maybe you wait till the next deal comes and you have saved an adequate amount. But it's really about the numbers, understanding the risk, and that's pretty much it. So there are pros: quick, easy, inexpensive, no credit check. The cons: the risk of not being able to pay it back, or the other asset not performing, and you lose out on your future taking a risk on something today. So I'd love to hear your thoughts on it. Would you do it? Have you done it? But please like, share, subscribe, keep the questions coming, and I'll see you next Tuesday.